Welcome back to Golden Roll Radio, where we analyze the metals market and try to make sense of what's going on. And as we've gone along here, we've had some things pop up just in the last week that may go against some of the seasonal trends we've been talking about here. We've got May and June being seasonally flat to weak months with gold. Been talking about possibly a pullback, but yet, wait, Monday night, here comes the Federal Reserve saying they're going to start creating more money and buying exchange-traded funds. So you have this injection of money from the Fed. You have a $3 trillion package put out there. Who knows what's in the package? We'll find out later, right?
Right. Isn't that how it works?
$2 trillion in the first quarter, $3 trillion in the second quarter. Wonder what it'll be a month from now. So we have a lot of money being created, and I think that eventually has to put pressure on the gold price.
I agree. We talked briefly last week just from a simple definition standpoint of what is inflation. That's the expansion of credit and money supply. That's exactly what we're seeing. That doesn't mean necessarily that right away prices climb, though, because that's the technical definition of inflation.
No, in fact, quite the opposite in the Dow this week.
Yeah, no, that's right. And so we're seeing this deflation. We talked about that ecospasm, that term that Don coined, where you get inflation and deflation at the same time. Well, what's deflation? That's a contraction of credit and money supply. And you are seeing some of that through the equities markets contraction, through line of credit shrinkage, all that. And prices actually drop as the currency increases in value. Well, we've seen the U.S. dollar increase in value a little bit, even though we're today? 100.25, kind of stuck on the U.S. dollar index. But despite all that, Robert, you're right. Gold has been very strong. It just almost refuses to go below the 1,700.
Well, and obviously when you're the Fed, you only have the one tool, right? When all you have is a hammer, everything looks like a nail. And that just seems to be their response to everything. And like you said, you'd expect to see some of the other markets responding positively, but of course we've seen the exact opposite of that. Gold, of course, after we recorded last week, we did have a little bit of a pullback down to around 1680, but nothing but strength ever since. And we're coming into the top end of this declining channel. So in the next day or two, should see either a reversal back down by the end of the week, maybe back down into the low 1700s, or if we push above now, we're testing the highs from a month ago, back up 1740, 1750. So nice little breakout point. Probably by the time we get this show up Thursday or even Friday, we should see which direction gold wants to go.
Yeah, and it really does bring up the question, why do you own gold, right? I mean, if you see currency strength and maybe even in equities markets rebound, but what you don't understand is that over time, the dollar weakens. I'm going to throw this chart up here that we've produced. It just kind of clearly points out the fact that gold's purchasing power is maintained over time. It's the dollar's purchasing power that depreciates. So that's why certainly gold was at $50 an ounce in the early 70s, and now we're at $1,700 an ounce. Sounds like that's been a great investment, but unfortunately, as the chart reflects here, it's the dollar gets weaker and weaker over time. And just because it's at 100 on the dollar index does not mean that it's strong in its purchasing power. It just means that it's stronger than other currencies related in that basket of currencies on the dollar index.
You know, we talk a lot about gold on a short-term basis on the show because it's a weekly show, and we've been oscillating between 1680, 1720-ish on gold, about a $40 range, and compressing around the $1,700 level. And in the big picture, if we were to fast forward a year from now, I'd be willing to put a lot of money on the fact that gold's going to be significantly higher.
Probably above its all-time high.
Probably so.
Isn't far away.
Yeah. Bouncing around here, especially in these seasonally weaker months. We're not talking about a short term here, even though on the weekly show we are trying to figure out where it's going week to week. But in the bigger scheme of things, you've got a massive amount of potential energy with the amount of money that's been created. And ultimately, that's going to put pressure north on the gold price.
Well, and you've already talked about how many trillions you're talking about. And really, it's going to already have exceeded 10 trillion when you bring the Federal Reserve and sort of the shadow stimulus that they can do with muni bond buying. And, you know, here they are turning out $41 billion a day. I mean, how quickly does that add up? And yet you don't really see it measured in the federal budget deficit. You don't see it in any budget. That's the beauty of having a central bank with a fiat currency, is you may never ultimately be able to measure the impact directly and indirectly through the derivatives markets, but it does account for already over $10 trillion in stimulus.
beauty of the central bank is an interesting phrase.
The beauty of the central bank model if you're
Right.
a Keynesian economist. How's that,
Okay,
Miles?
that's better. I'll take that. That's a little more clear.
Where does this stop? Where do they stop doing this?
Well, after our conversation earlier, it stops when state governments are asking the federal government to completely bail them out as a state, right, Tori?
That's
Isn't
a
that
great point.
something you're really looking forward to?
You're trying to rile me up.
Poke the bear.
Yeah, I may have to leave the show now because I'll probably say something that I regret. But no, that's what draws the line, quite honestly, is if you can have irresponsible spending and budgeting on a state and local municipality level, only to ultimately be bailed out for that, then we have no system of government that's worth supporting anymore, right? You've got to totally hit the reset button. And I think that's what a lot of these states are hoping for. Robert, you already alluded to the $3 trillion stimulus package, and I don't want to get all political on the show, but this is behind the doors, closed Congress type of dealing, and then they come out and you see where they want the money to go, the extent that they want it to go to, the states that they want to try to help bail out. And I'm telling you, it won't stop until you just literally have to completely default on debt.
I think the takeaway from all that is that it's not going to stop, right? And we haven't yet seen an equal balance between how much money's been created and it showing up in the price of gold. And I don't know when it does, but it ultimately will. So I think the takeaway or the action to take related to that would be to position ahead of it actually having an effect, because I don't see it stopping. They're just continuing to have a higher and higher amount of money that they're coming out with. And ultimately, that is just a bad idea to be holding dollars, sitting there doing nothing for you.
Thank you. I mean, and you have this opportunity to be ahead of the curve right now.
Ahead.
The impact
That's the
hasn't
key.
even been felt.
It hasn't.
No. And so if you know that they're debasing the currency like that, what in the world are you doing sitting in tens of thousands of dollars in your checking account, in your savings account? What are you doing?
Well, I also noticed in a savings account, the high yield savings accounts online have gone from 1.6 or 7 down to now it's 1.3. So you've got currency debasement clearly out there from the Fed and the government, but then also you've got the bank saying, oh, wait, we're going to lower the savings rate. I mean, this was just in the last couple of weeks. Now it dropped down to 1.3, I think is the highest that I've seen, in a high yield savings, but it's already starting to have an effect just in the online savings, high yield savings accounts.
Well, and I like what we've seen as gold has played Mercury in the thermometer for the last couple of years, because this obviously right now isn't the first crisis we've faced. I mean, we were having a very different but similar conversation 6 months ago with the overnight repo market. It's not like those things go away. Those are still major international issues that we're having to deal with. So gold, of course, we're now up, $600 and something from the bottom in 2015? But you compare that to some of the other commodities, especially commodity metals like silver still under $16, platinum still under $1,000. Oil prices, my wife was just up in Denver. It was less than $2 a gallon for gas. So you look at how some of these other commodity prices are moving, and you compare that to this discussion about the value of the U.S. dollar, the printing of money, the expectation for additional printing money probably ramping up substantially. You have states coming to the federal government possibly at some point in the next 6 months. How many billions, if not trillions? How many trillions does it take to bail California?
Right.
So you start adding all that up, and to think that oil prices, I mean, granted, we have a glut of oil. The nice thing about us reopening U.S. oil is that we have a lot of oil now. But what about other commodities? What about food?
It's going to ramp up.
Food is becoming an issue.
That's right.
And then what about the commodities that we're looking at? So there's a reasonable argument to say, have I missed some of the gold move? Yeah, of course you have at this point. We're up $600. Even if it goes to $5,000, you still missed at least part of it. That doesn't mean it's not still a heck of a move ahead of us, but then you look at things like our ratio trading charts, and you look at where silver is, and you look at where platinum is, and some of these other industrial-driven metals. When that inflation comes home to roost, that's when you see like 2010 silver, where in 9 months it goes from, $7 to $50?
I'm so glad you just said that, because right now we're at the end of 2008 for comparative purposes, early 2009. Okay, before TARP, before QE1, QE2, QE3 really had an impact on pricing, right? This is the window of opportunity that we're trying to talk about. A loaf of bread went from $1.50 to $3. What happened? Gold doubled. So what happens when a loaf of bread goes from $3 to $6? Is that so unrealistic? No. What's going to happen? Gold's going to double. All right. Again, it's purchasing power preservation. That's all it is. But look at your opportunity here in terms of what gold and silver did in that period of time when it started to realize the impact of the sheer magnitude of the number of dollars that were pumped into the system.
So I know we're getting off into the weeds here a little bit political, but it's kind of hard not to, just given what's been going on. So also on top of the fact that with the other white metals, we are just seeing the same type of compression in those, in fact, even more so than what we just looked at on the gold chart. So we're going to continue to watch these. There's not a lot of song and dance here. We're waiting for a breakout one direction or the other. You can see the silver chart is consolidating just a few pennies up and down for the last week. Platinum is as well. The big difference, of course, is palladium. Palladium continues to stair-step down. I think we're off another couple percent. So we'll throw these up here to take a look at and a couple lines drawn on certainly the silver chart, because I do think we're right at that breaking point for silver.
This time last year is when we were sitting at 1270, just to throw that out there, 1270 on gold.
Remember, it was stuck too.
And we said that was your opportunity, and it started moving higher. Here we are, 1700-ish. And if we see weakness, that's your opportunity. If we don't and it breaks out here, then it's going higher. You know, again, reiterating the seasonal pattern, should hopefully see some weakness, but with everything going on with the increased amount of money, it could very easily just break out to the north here and keep going higher. So this is the time to be adding, and especially on any weakness. So making that call to you.
And I get trying to get lower entry point. I understand
Absolutely.
that from an investment mindset, right? And so on pullbacks, yes, you're adding in. But I'm going to tell you what I tell my clients. If it closes above 1750, you better get in, because there's no resistance. I think, Miles, you've even touched on this.
Right.
But from 1750 to 1850, or even the all-time high of 1920, it's just going to go almost unchecked. And that's not very far away. I mean, you're less than 15%. That's nothing.
No, you're not sitting on anything that's going to react to previous pricing. So any type of pricing movements in that range, all you're going to see is just current bulls and bears fighting it out today. No standing orders.
So last week you mentioned palladium. I don't want to let you off the hook. You felt pretty bearish on that last week. What's that done this week?
Yeah, looking at the palladium chart, I mean, we had this double bottom back in the beginning of May, little pop back up, but the pop-up didn't do anything but get to the old lows. So we're not really seeing much of anything that would hint towards a reversal back up in palladium yet. You could see something like a push down to 1600, which gives you a 3 downward drives, like an Elliott wave, 3 drives down, and a reversal back up there. But I think we've got at least another $100-150 down in palladium. And that's going to tighten that ratio up. Losing your platinum opportunity the longer you wait.
Speaking of missed opportunity, we don't want you to miss the opportunity that is upon us right now here in May. We think that it's the time to be adding to your positions or starting new ones. We have a good selection of gold and silver coins, and as you may have found out there, that it just isn't a lot of things available. And so we have taken the time to put this together for you. So we invite you to give us a call, talk to an advisor about what we do have before it's gone.
Yeah, specifically even junk silver, silver rounds, the generic rounds, and silver American Eagles. Give us a shout.
So before we close out the show, I think it's worth bringing back and looking at the charts based on the conversation we had earlier, because when you do see a good collection of money going into the markets that the Fed and apparently Congress decide who gets and who doesn't, but when you have that money going in, you do tend to see sort of an anticipatory increase. We haven't seen that this week. The Dow clearly trying to turn bearish again. So the Dow trying to rebound back up. We talked about this last week. Robert brought up the S&P, the Dow lagging behind that, the Dow transports lagging even further behind that. So the Dow failed to get up to the 618 like the S&P had done. The Dow has now put in a lower low and a lower high, and we now seem to be building a channel pointing back down. So my argument would be, if we see a break below, let's say about 22.5 on the Dow, we'll have this nice rollover looking to go back down and probably test the lows around 18,000. The transports are absolutely leading the way, as they tend to do. So I would definitely be hesitant to jump back in to the equities market at this point, because we're not even seeing any type of anticipation rally of money coming back into the system. I don't think there's any faith. I think faith is broken.
Wait, you're saying you would be hesitant? Doesn't that go against what most of the financial advisors are out there saying to their clients right now? Because, I mean, as I talk to people on a weekly basis, people who have money managed, they're sitting there being told that this is a buying opportunity. They should be staying still. The market's going to come back. The world's going to open back up. We don't think that way.
Sure.
I think that it's categorically bearish, the stock market has turned. And with these technical indicators, with the S&P hitting that ceiling of the 618 retracement, the Dow failing to get there, the Dow Transport's obviously failing to even get back to the 50% line, you might be seeing a major rollover here in the stock market.
Yeah, and it actually reminds me of December of 2008 and January of 2009 and February of 2009 when the financial advisors were saying the same thing. The market didn't end up bottoming till like May, and people continued to get decimated along the way. Look, the opportunity is going to come. The value in the equities markets will someday be there. But this is long overdue, this washout. And they've done a masterful job so far of pumping money in and trying to prop it up. It's broken. We haven't even gotten Q2 numbers yet, and we won't until July. And then you'll see corporate earnings. Then you'll see the true unemployment numbers. Then you'll see what's reopening. And I'm telling you, Q2 is going to destroy this equities markets beyond a short-term V correction, right? It's going to take some time. And you've got to expect in the second and third quarter to have continued equities weakness, despite yet supported by the technical analysis that you guys just pointed out.
What also blows my mind when I talk to people is that they have the majority of their money in an equity portfolio that is just riding this wave. And they might think the way that we are talking about here on the show, and they might agree with us 100% that there's trouble ahead, blah, blah, blah. But they only do a petty amount in gold, like 5, 10, 20% in gold. But the majority of their money is sitting here just totally exposed to an equity market downturn. I'm the other way around. I'm not going to participate in a market that's way overvalued even still. And it just continues to blow my mind when I talk to people. They agree, but yet they still just sit there and let their money be exposed.
And it takes a couple weeks to roll over an IRA, to roll over a 401k.
Sure.
You know, the CARES Act just gave everybody a gift where you can take a portion of a 401k and move it into a traditional IRA if you've been negatively impacted by the coronavirus, right? These are amazing opportunities in the coming weeks to actually protect yourself and take a portion of an IRA or a 401k and put it into gold and get your percentage up. And then we get 1 year, 2 years down the road, and you can look back with hindsight and be thankful for the fact that you took those steps.
Well, and it may not be a bad time to talk to your financial advisor and just ask them, what kind of cash position am I sitting on? Because, you know, we look at, say, our sister company, McIlvaney Wealth Management, and the cash positions they're sitting on right now. Talked to a financial advisor buddy of mine yesterday. He's sitting on substantial cash positions for his clients. But they're also talking to companies like ours on top of that. So there are definitely people out there who are seeing this as a bigger picture. But it may not be a bad time to have the conversation. Just say, hey, are we diving in? Are we being hesitant? Or are we being scared? Because there are 3 different ways you can react there. And the 2 on the outsides, I don't know if it's the right decision to be either diving in or scared. But there is a proactive, productive way you can approach markets like this because they do come around about every 10 years.
That's exactly what we've seen here in the last 5 weeks. Wouldn't you guys agree?
Sure.
A very thought out, pragmatic approach to rediversifying portfolios.
Exactly.
Yeah, and I think going along the lines of you should take advantage of it before the big wave comes with gold, I think you would be ahead of the crowd moving now.
No, great points, Robert and Miles. And I'm just going to say, look, I've never been more affirmed by what we do than I am right now. And I can't sit here and stand up and scream and do all sorts of stuff that like is an emotional rant. But I'm serious. This is an amazing opportunity, and I'm going to earmark this show, and we can go back and listen and say, look, we were standing on the rooftop screaming. Now is a really good opportunity from a timing standpoint. Everybody be safe, be healthy, be well, but be smart, be prudent. You have an amazing window of opportunity here. Take advantage.
So that's going to do it for Golden Rule Radio this week. We appreciate you stopping by. If you liked what you heard, click the subscribe button, ring the bell, head on over to Twitter at ICA Gold, Facebook at McIlvaney Financial. You can find us on our website, McIlvaney.com. Or if you have any questions or would like to speak to one of our advisors, you can give us a call anytime at 800-525-9556. Thanks for listening. Have a great week.